All right, one of my subscribers wanted me to analyze Altus Power, and I can tell you right off the bat that I kind of like this company, so let's get to it. So, yes, in the past 5 years, they are down quite a bit. They're down 62%, but I think that this may present a buying opportunity based on a few different things. This is in the solar power generation space, and we know that solar power is getting built out a lot, and so this company has been growing quite a bit. Even though their share price doesn't show that. They IPO'd back in 2021 at $10 a share, and they tried to keep it there, and it has slowly fallen all the way down to 383. So they are a $600 million company, and they've been growing quite nicely. Their statements here. Their revenue has grown by 40% and then 50%. So accelerating growth there, and even in the last quarter, they grew by 40%. So very solid growth. Probably expecting like 30% growth moving forward, I would say. I think that that's fair. And then the only problem that I see is their margins. So they do have a gross profit, but then when you account for their operating expenses, a lot of times they do have a loss. Although in Q3 it looks like they had quite the gain, and in Q2 they had quite the gain, but Q4 and Q1 looks like they had operating losses. So not quite sure why it's so much different in those two quarters. Maybe Q2 and Q3 are going to be better coming up, but yeah, I'm not quite sure why it's like that. But look, okay, so here's the deal with this company. They have fallen by 62%, and a lot of times that's because a company is losing lots of money, but this company is not really losing tons of money. And usually companies like this that fall kind of consistently over time, they're doing lots of share dilution. But this company is not really doing a lot of share dilution. Also, they're not really losing all that much money. So they're like very close to turning profitable. But then you look at their share dilution, and okay, this was before they IPO'd, but yeah, they're barely diluting you. So maybe like 1% or 2% a year. So that's not really a big issue. And in terms of their balance sheet is pretty decent. Their book value has been growing, although not in the last couple quarters. But their net debt keeps on growing because they take on debt in order to fund their solar projects. 1.33 billion in net debt. So we'll have to take that into account when we do our model. But most of the time with power companies like this, it's not really a huge deal. I mean, they have to take out debt in order to build out their infrastructure, so it makes sense. And in terms of cash flow, their cash flow is negative because they are spending so much money on capital expenditures. But they do have cash from operating activities, and that's a good sign. They just have to spend a lot on CapEx in order to grow. Taking a look at their stats, and yeah, this stuff's not going to be all that helpful because they have negative margins right now. So when we do our model, we're probably going to use the revenue margins model instead of earnings because they don't really have much for earnings. But yeah, they basically put solar panels on people's roofs or on like commercial roofs. Let me show you. Okay, a picture. Yeah, like this. So they put solar panels on top of commercial building roofs, or they'll do fields, or they'll do community solar projects. So lots of different ways for them to install solar. And then here's where they've got all their projects. So they've got projects all over the place, honestly. They've got a bunch in Minnesota for some reason, right? Like it snows there. They've got a lot in New York. They've got a lot all over the place in California as well. Yeah, they also partner with CBRE, which is pretty sure that's a REIT, a pretty large REIT. So they're probably going to get some more customers through that. Like most of their growth projections are pretty solid. Let's check this. So this is their unit economics, and they're basically saying that they're going to be able to get a 13.5% levered internal rate of return or an 8.5% unlevered internal rate of return. So probably that's going to be most likely kind of what the returns you'd expect from this company. Also this guy said that they're financing their stuff with 3-year callable debt. So if interest rates drop, then they are able to call those loans and refinance at a lower rate. The other thing that I like about this is when you look at the holders and insider transactions, you can see that there have been 17 total purchases and 9 total sales, and they've purchased way more shares than they've sold in the last 6 months. So that is probably a sign of undervaluation. The insiders definitely think that this company is underpriced. Yeah, you can see a lot of sales here, but then you've got some massive purchases in here as well. Yeah, purchase at price, right? 1 million purchase here. Yeah, a bunch of purchases, but also a lot of sales. Although some of these are indirect sales. Okay. Anyway, I go to the analysis because I usually use the analysis. Oh, let's check the short percentage if there is any. Okay, short percentage. Okay, short percentage is actually quite high. 16%, that is kind of a red flag. But I don't know, man. With the amount of insiders, it's kind of it kind of balances each other out. Like the insiders are buying, but there's also a lot of short percentage, so it's a battle between the two. And then I like to use the analysis tab for the projections into the future. They're thinking 35% they're going to grow this year, and then next year by 20%. So I plugged that stuff into the DCF model. Let's take a look at that. All right, we're going to ignore the earnings model, and instead we're going to use revenue margins. So they are projecting they're going to have like a 0% profit margin next year, and I'm thinking that they're going to be able to get a profit margin at some point. So that's why I have their profit margin finally expanding up to 10%. It's definitely possible that they get a little bit higher than that. It's definitely possible that they aren't able to get to that amount. Their growth is probably going to be around 20 to 30% a year. So I think the growth projection is fine, but the margins might stay low for a while. So I think this is kind of optimistic to think that they're going to get up to 10% margins in 6 years. But it definitely could happen, especially if interest rates drop and they can refinance. Then that's going to help their profitability a lot. So using this model, I came out with a fair share price of $5.49. However, they do have a lot of debt. So when you account for the debt, it actually goes negative. So I probably put their fair share price around like $3, around like where they're trading at right now. That's assuming that these projections play out. So yeah, there's a lot of things to like about this company. There's also a lot of risks with this company, especially the fact that they're not making money. However, they are investing a lot in their growth, in their business, and I think that really makes it quite favorable. Also, they are a small company, so they do have lots of room to grow. I think that I would open up a small position in this, especially if interest rates drop. This company is going to benefit massively. Yeah, and they're in that solar area, which is a growing sector of energy. So yeah, there's a lot of things to like. There's a few risks, but overall, I think it's pretty solid. Let me know what you guys think in the comments. Also, make sure to hit that like button, and I'll see you in the next video.